Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, July 26, 2016. In this video, we'll take a look at the biotech stocks. I think there's a lot of key levels right now, important technical levels to watch, as well as some recent technical developments, chart pattern breakouts, divergences, things that really stand out. And this video will be a little bit different. I usually, one of the main goals on my site, what I try to do with Right Side of the Chart, is provide streamlined and unambiguous, I should say. Unambiguous analysis, meaning I usually won't sit there and provide, 3-4 different scenarios and market can go up, market can go down, this may go up, this may go down. No. We all know that any stock or security of the market may go up or down. I'll get them right sometimes and I'll get them wrong other times, but if I see something that stands out and I have a strong enough opinion, that is, to make a bullish or bearish case, that's what I do. Now, what I'll be doing in this video is making both a bullish and bearish case, and I'll tell you why. I'm doing that because I think the biotechs are at an important inflection point. I think there's a lot of money to be made in this sector, and it's either going to be made on the long side or the short side, and I'm referring to the next several months to the next year out. And so I'll go over those levels, I'll go over targets and things like that. So for whether you're a bull or a bear, or you don't have an opinion right now, or you may flip from bullish to bearish, you're going to see the levels that are important. That's what I'm watching, and really what will determine which way these things break. And right now, it's hard. I don't want to say it's a coin toss. I still lean towards that downside, longer-term bearish outlook, but I'm completely open to all possibilities. And somebody posted a question in the trading room the other day and said, Randy, what's the longer-term outlook for the biotech stocks? And somebody jumped in jokingly saying, well, they're going to go where the market goes. And that's actually, as simple as that sounds, those are my thoughts, and I chimed in, and that's true, because I think the market's at a very important inflection point. Most of you are probably aware that there's a lot of banter out there right now in the financial media, and I'm sure on websites and trading and investing sites and newsletters, whether we're in a new bear market or on the verge of a new bear market, or the last couple years. Let me highlight this sideways consolidation. This is also known as a deer market. A bull market is when the overall trend, the primary trend, is rising. The stock market's rising. A bear market is when something's going down. A deer market is sideways trading, and neither a bull nor a bear. So we had one in the early 90s before the big run up all the way up to 2000. We had a deer market that really connected two bull markets. And that's what this has been. Now, that's in a way that's healthy for the bullish case. The bullish case is that this has been a sideways market, and it's been enough to work off the overbought conditions. What I mean by that is the bull market, or the stock market, was extremely, or persistently, I should say, overbought for an extended period of time. And that's normal. In bull markets, overbought, number one, can become more overbought. What I mean by that, for those of you not familiar with the term, we usually use one of the most common indicators used to measure overbought is the RSI. And readings of 70 or above are considered overbought, while any reading of 30 or below, the blue line, is oversold. So in a bull trend, whether it's a stock or the market, overbought readings are common, and it's also common that once you become overbought, that you become overbought again. You have a little pullback, and again, you may hit that overbought level and become quite a bit more overbought. So you don't short or really become too concerned if you're long about overbought readings, because as I showed you here, they can stay overbought for months, if not years. However, in a bull market, oversold readings are very rare. They're often very fleeting, and they typically prove to be excellent buying opportunities. We haven't even hit that 30 level, ironically, throughout this whole sideways period. And now the flip side, the inverse of that holds true, by the way, in a bear market. That oversold can and often does become more oversold, so it's not by any means a buy signal or time to be on the lookout for going long, and we can stay oversold for an extended period of time. So I wanted to point that out, that this may or may not have been. It's still not my primary thesis or belief that this was enough consolidation to launch a new continuation of either a continuation of this bull market, which up at the point was I think it was the second longest in history when I checked, sometime back in 2015. I already saw stats putting this as the second longest one in history. And if we break out of here, it would essentially be a continuation of this bull market. So we would have, certainly by then probably shattered all records. And anything's possible, but history shows that we're really, really long in the tooth. But again, was that consolidation up? Maybe, maybe not. All right, I don't want to spend too much time there, but I'll just point out all the other indexes. There's the NDX, and also you note on here the trend lines. These were the bull market trend lines that broke. I just had one on the S&P 500, backtest, a breakdown, backtest, and rolling over. And all but the S&P 500 eked out to a marginal new high, but that really doesn't mean, in my book, it means very little. I mean, sure, new highs on face value are bullish, but I short trendline breaks and I go long trendline breaks all day long, and it's not uncommon to see after a trendline breakout, let's say if it's an uptrend, to see prices come in and backtest and make a higher high before rolling over. And how long that can happen, it's relative to the scope of the trend line. This one goes back to 2009. So the fact that we did have a backtest there, rolled over, and didn't crater means very little. We can still come up to any point, as long as we don't come up 3, 4, 5 years later, then that trend line at that point is insignificant. But right now, that is a trend line spanning up to the point it broke down and was back tested here at the first time. What is that? 6.7 years, almost 7 years into that, guy. So again, so my point is, this thing can go either way. I still favor the bearish case at this point in time. And if the markets continue to just push higher and especially burn through those divergences I've talked on the daily time frame, I'm not going to get into a whole overview of all the broad markets right now. I just wanted to show you that, you look at any index. Here's the mid caps. We'll do it with the mid cap index. That's the tracking ETF. We're testing those recent highs. But the story is the same. Wrong drawing tool, folks. Let's try to grab this. The story is the same. We've consolidated in this range for the last 2.5 years, and we're either sooner or later, and more likely sooner than later, we're going to break out to the upside and have a sustained advance. Even if it's we'll see. We may come in and backtest that level. If all the other indices break out, maybe they need to come in and backtest and then move on higher. That would be my preferred scenario on the bullish side. Or we move back down low, and if we get back down to the bottom of the range at this point, that would almost certainly be the final straw, and then we'd probably break down very shortly. In fact, I don't think we'll come back down and test it. I think we'll just come down and run right through it if we get there. All right, enough on that. So that, again, will determine where the biotechs go. I can assure you that if the broad market, the S&P 500, the NASDAQ, small caps, mid caps, if they're all headed up another 20 or 30% higher, I don't know what kind of crazy numbers people are calling for. I don't know where the market's going to be 3 or 4 years from now. I'm looking out near term. But if we're headed up another 20, 30%, the biotechs, there's a lot of good buying opportunities right now. Maybe not right now because we're at these resistance levels. Let's get on that and talk about it. All right, we're going to go to XBI. We'll start out with a weekly chart. I'll talk on the leveraged ETFs and some of the other biotech ETFs if we have time here, because I track XBI is the one that I follow the most because I can trade LABU and LABD. LABU and LABD track the exact same index. The spiders, they track the S&P 500 Biotech Select Index, as does XBI. So when using LABU or LABD as my trading proxy, because of the decay is awful in those things, and that's why I short them instead of go long. Whether I want long or short exposure, I'll short one of them. And but I won't use those for charting purposes because the decay renders an inaccurate technical picture. So we're looking at XBI here, and we're looking at a weekly chart, and that's not the one I wanted. There, this is the one I wanted. All right, I'm going to start out with the longer term picture and make the bearish case. Then I'll get to the daily charts where I can certainly make a bullish case on these stocks. However, right now, what I see, and just to back up real quick, if you're new to the site, you know, the biotechs just came off one of the strongest bull markets of any sector in recent history. From the 2009, we had a double bottom low here. See, 2008, 2009, we double bottomed here, and we gained, what was it, about 550% off the lows, somewhere around there. So a tremendous bull market in the biotech stocks. We broke down from this bull market up to this minor uptrend line, then this primary uptrend line, and right around the top, give or take a couple days, couple weeks, you know, I put out a video stating, you know, very clearly that my expectation that a bear market, not a correction, a bear market in the biotechs was imminent, and we made, I mean, I did very well, and I know a lot of people on the site caught some of those trades, shorting those down. In fact, we covered right into the lows. One of the trades I put up was LABU, a short on LABU to soak up both the decay and the move down, and we covered that. I think it was early February. Let me see, I have it on another screen. Yeah, we closed LABU on the site, you know, as an official trade for an 85% gain on February 3rd. And so we were short near the highs, and we covered within, you know, days of the lows. And that's not random dart throwing, that's technical analysis. It said that a significant top was there, and also warned get out, and in fact I went long. We had official long trade ideas both on the ETFs and individual ones. So now where we're at now, my confidence is not as high. I will tell you that I personally own, and I have owned all the way back here. I started this 57.70 level was a level I was shorting LABU because I like the decay. I like to use the leverage ones because even if I'm early on the move or wrong, well, you can't be wrong. You can be a little wrong, but if you're early and you have sideways trading, which we had, the decay works in my favor. So yeah, I shorted there, shorted here. I was hesitant here, and I've held off, and I haven't added, and I would like to, and I just went underwater on that position last week after having really some healthy gains on both of these two pullbacks. But this was a resistance level, but this is a more important resistance level now, and like I said, I'm just holding off. I'm keeping things light right now personally, and obviously if and when I have the confidence to add the biotechs as long or short trade ideas, I will do so as official trade ideas. Now, just because I'm conservative or you know, keeping things light now doesn't mean you have to be. I'm doing this video, so hopefully you can take trade ideas from this, whether you're bullish or bearish on the biotechs. These are the levels I'll cover, the important levels to watch and the important developments. So what do we see here? We had a divergent high recently, and that led to a healthy correction, but forget about that because that's now already played out, so that doesn't mean much anymore, that divergent high right there. What does mean much to me, or a lot to me, is this 59.90-ish level, we'll call it. Oh, 59.90, you can almost call it $60, isn't much above that. So let's say around $60, I see a pretty key level in XBI, the biotech ETF. We have, you know, that's where we're at right now. We had this previous reaction high, and the reason there's a line there, we had a major reaction low right there, and a very important reaction low there from that sell-off. And you go to the left, there was a little bit, you know, of trading around that area, but more importantly, it's these two previous recent reactions off that level and this failure right here at that level. So there's an important level. If that gets taken out, this 63 level, well, let me say this, if that gets taken out with conviction, that doesn't mean a day we close one day above it and then fall back below it, or just barely close above $59.90 or $60. But if you start moving up through there, this is the next resistance level at $63.50. And it's a pretty well-defined level, and it also lines up with some Fibonacci clusters, which I'll touch on in a second. But we have a gap right here. We have a reaction there. You go to the left, you can see reactions there from above, and you can see reactions from below. So my take on the biotechs, and I'll watch the broad markets, of course, because if I see the broad markets rolling over and the biotechs are moving higher, then it's only a matter of time before the biotechs will follow, because they will follow the broad market, give or take, you know. So the way I see it, as and if we start moving above the $60 level, this starts to pretty quickly diminish the bearish case in the biotechs. It'd be bullish to take that level out, and any move or breakout, solid move above 63.50 will just rapidly erode and almost wipe out any the bearish case. It will have put us back above that 40-week moving average, which if I didn't talk on it yet, I'll talk on that in a second here. The 200-day moving average we're testing right now, or a little bit above. So this is a level I'm watching, 63.50, but before then I'm watching this 59.90. So if you're bullish, you go long here, or at least I would say make it safe, wait for a close at least above 59.90, maybe $60. Or you go long with stops in place if you are confident that we'll take that level out. On the flip side, if you are bearish, I believe this is a very objective shorting level. As I just went over, that's a significant level. So anything up to, but not above 60. You don't want to dig yourself in a hole. So if you want to take a short on, if you can do it, LABU, adjust your position size down 1/3 to account for the leverage. What I mean by that, if you take 30,000 in a position, only short 10,000 at LABU, and set your stop above 63.50 on XBI. Again, I like to use the chart at XBI because it tells the true technical picture. It doesn't have the decay in there like the leveraged ETFs. And if you're long, these are all levels right here. I'd have to say, you go long, you probably want to give it down to about 54.73. And if those seem like wide stops, guys, the biotechs are almost as volatile as the gold mining stocks. These are two of the most volatile sectors I know. And if you can't stomach, daily swings of 3-4%, then you're trading the wrong index. And to trade them successfully, you have to allow wider stops. And to do that, you also need to target larger price swings, which is easy. To move on these guys, a 20-30% run in the biotechs is run of the mill in a swing trade. So what you do to account for that is just keep your position size a little smaller. If you're usually targeting trades for 10-12% gains, but you want to go in the biotechs and shoot for a 30% gain, adjust your position size down by another third. And what you're going to do, if your loss is 3 times bigger in percentage terms than normal, it's going to be the same in dollar terms. Likewise, that profit that you're shooting for, that 30% profit, will be the same profit if you hit a normal trade with a 10% gain. All right, so there's the biotechs. There's a level I like, or I'm watching. I'm sorry, those levels. This will start to strengthen the bullish case, diminish the bearish case, and then the 63.50 level, and I'll show you why here. Let's look at another chart. I have some Fibonacci clusters here on this board. Same chart, daily chart we're looking at. These purple lines, the colored lines, are Fibonacci retracement levels off this recent low from the move down. Well, the purple one starts the move down when the biotechs peaked back last year around July 20th. So we have this move down into the lows. That's what that measures, that purple line. Then we have this key reaction high here and another major reaction high right here. Okay, so that's white, blue, and purple. You can see right now we're trading. Remember on my chart that 59.70 level or whatever it was, wherever I was, 58.70, I'm trying to recall. This whole area, it's a Fibonacci cluster. You can see 2 fibs here, 50 and the 38.2 of these 2 lines, the blue and the white. Then above that, we actually have all 3 overlap. This is a very strong Fibonacci cluster right here. You can only see the numbers are all overlapped right there, but if I move this one, you'll see it. So you can see the purple and the white, and then I put the line back where it was. So this is a very strong fib cluster. All 3, they're not all the same levels, obviously, the same retracement points, but they are key Fibonacci retracement levels, and they align with that 63, whatever called 63.40-ish, 63.50th level, roughly. So that is, again, a very important level. And you know, I won't be, it depends where you're at, guys. Don't forget about what I'm doing, because my positioning, if I didn't have any position in XBI and we got there, I would be, if the broad market's confirmed, that's where I'd be looking to add a short exposure, long term, you know, put a short with a stop not far above it. It would be very objective. Likewise, if we get above there and the broad markets are doing well, I would consider, you know, adding long exposure. But that's not right now. I'm just kind of watching these levels, expecting the broad markets to roll over soon. And again, I favor the bearish case. I do think, and I may make it official soon, biotech short here. But let's get to the individual components, and then I'll show you why I haven't done so. Okay, to wrap this video up, we'll go through the stocks, the top 10 holdings in XBI, which again is the S&P Biotech sector, same sector that the LABU and LABD track. And what I did, I went to their website. I'm actually looking at it on another monitor, the top 10 holdings. Now the top 10 holdings, which we'll go through, I put them here on a watch list. You can see them there. They comprise, I think it's 26, a little over 26% of the ETF's performance. They make up 26% weighting. So really a quarter of it comes from these top 10 stocks. So if you want to know where the biotechs are going, you get a good pulse on where these stocks are going, and then you can trade XBI, or you could trade these individually. IONS. Okay, this will be where I show you bullish and bearish charts, a lot like what I did. You know what? I don't think did I do the weekly chart on XBI? No, I'll do that in a second here. But I'll make the case with these individual stocks. So on the daily time frame, which we're looking at here, and if I'm talking fast and don't make mention, up in the upper left-hand corner shows you the time frame we're working off of. See this divergent low, very strong divergent low. Price has made this lower low, bullish divergence. Right now that stock is, this is a key resistance. This is a level to watch here. It's a little shy of resistance. The top of that gap around 30.12-ish. See this gap I'm referring to right here? We've already entered the gap. I should have a line here at the bottom of the gap. So we've entered the gap. Don't put too much in this downtrend line. There's not many reactions. Let's get rid of that for now. So this is a stock that, you know, it's moved off that divergent low, and you would expect at least this move. But we're coming up on significant resistance here. So you can take the glass half empty, glass half full. If you're bearish, keep in mind that, as I said, just as in bull markets where bearish chart patterns tend to either fail, or if they start playing out, they fall short of expectations. In a bear market, if this is still a larger bear market in the biotechs, which again, the longer term charts to me still indicate that. Certainly the bottom could be in, but it's just not there in the charts yet. If that's the case, this divergent low, which normally in a bull market, I would have been all over the stock like a cheap suit. Again, if I saw that, I wasn't watching this particular one at the time, and I was, you know, long quite a few of the biotechs when they bottomed earlier. But this one's a little different. The rest of the sector bottomed back here. So this one you can short it any point here with a stop not too far above the bottom of that. The top of that gap there. You have another reaction there. You have a reaction back here to the left of the screen. So there's a pretty significant resistance level. And yes, it did put in a strong divergent low, which normally would indicate a lot more upside on that stock. And if you're bullish and you think that the biotechs and the broad market are going up, then by all means, you can go long, trail a stop, the very least maybe place a stop above this level. This looks like a pretty decent, this is a pretty decent support level, 2410 that is. And you can target, I mean, the sky's a limit. If the bear market is over in the biotechs, and this one's just coming off the bottom. So that's one of them. Let's move through a little quicker. I'll just try to hit on the levels. Next one up, that was a 3% weighting, 2.99. This is SRPT. They're all roughly, they drop down from here. The lowest, the 10th largest holding is a 2.43% weighting. So you can get the idea. They're all 2.5 to 3% weightings, roughly equal. In other words, there's no big 800-pound gorilla in this sector, at least not in this particular ETF. SRPT, great chart as far as technicals go. By that, I mean this stock acts extremely well off support and resistance. You can see three reactions here on this line, and that's where price is at. So we're at resistance. You can see going back in time, this level held like a champ. We should really work from the left of the chart. You know, it was resistance, resistance. Finally, the stock gapped up, coincidentally or not, right to that key resistance level. Battled it that day, closed above it, came in, then a few days later, you can see where that is, back tested it, so I'll add another shadow box there. Rallied up, fell down, found support for a few weeks, rallied up, gap below it, and so on a scale 1 to 5, that's a 5. Let me just say that for resistance. So again, where are you? Are you bullish or bearish or neutral? If you're neutral, stay out of these guys, because these things biotechs can move fast. If you don't know what you're doing, avoid this sector. But if you're bearish, you short here with a stop not too far above. Of course, check for earnings. I have not scrubbed any of these individual stocks for earnings. You don't want to go long or short a biotech stock the day before earnings, or if they have any anything in stage, any stage of clinical trials right now, because favorable or unfavorable results can that's usually what causes these large gaps. If they're not earnings induced, then they're caused by clinical trial results. So there's one. If it takes that level out, if you're bullish, these are all resistance levels. Quite a bit in that one. Again, if the bear market is over in biotech stocks, and assuming this one has okay fundamentals, and it should, it's one of the top holdings, should have a diverse pipeline, I would imagine. I don't know much about this company. Then it's probably heading at least back up to that level. So a lot of meat on that bone. And weekly chart, I don't have anything there. That Ionis, I keep mentioning that I wanted to talk about the longer term picture, in the biotechs. Ionis was the first one I covered. And again, I said how well it acts off, the technicals. Here was a bearish rising wedge pattern. It peaked about when the biotech sector did, and you can see the divergent high. This line here that I'm highlighting, and this makes a large rising wedge pattern. It was confirmed with negative divergence, everything I like to see. Breakdown, perfect back test, rolled over, and what I circled here is we don't have any bullish divergence. I know a lot of traders like to use the term, and I don't know who came up with it, hidden divergence. I'm sorry, I just don't agree with the hidden divergence. The whole point of using these price and momentum indicators is they, in a perfect world, they're going to follow price. If the price goes down, your PPO or your MACD is going to go down, so will the RSI, and that's how it should be, and that's how it normally is. Divergences are, the PPO and the MACD, they're momentum indicators, and that's what it's doing. It's indicating when a stock is falling. If the stock is making lower lows, yet the PPO or the MACD is making higher lows, then they're showing you the momentum is waning and there's a likely trend reversal coming. So anyways, I like to see that. It's not an absolute necessity when trading, but especially on a weekly time frame in a bear market, I really like to see bullish divergences at the end to help indicate that a primary downtrend is over. So this one did fall quite a bit, hit that support level, and bounced up. May have more to go if the bear market, and certainly does if the bear market is over, but again, that's just not there yet. And I'm sorry, I can't recall if I mentioned all that on XBI, but the things that I wanted to point out is XBI made a 61.8% retracement, which is a typical healthy correction in an ongoing bull market. And so the bull market may be over. I like to see, a correction run between 30 of a primary trend, whether it's bullish or bearish, run between 38.2, hit the 50, 68.1 level, and continue on. So this could just be a healthy correction in an ongoing bull market. However, the 40-week moving average here, it doesn't do a perfect job, and it's not going to do anything. Moving averages don't work at all during sideways choppy trending periods. Don't even try to use them as trend indicators. It's when you have an established trend. So you had an uptrend. That 40-week moving average has done a good job of defining the bull market when it was prices were above it. Then the bear market went below it. Sure, if you zoom in, there's a few weeks here and there. They pop up a couple weeks, but for the most part, you see it fail back. So we just popped above there recently, but not nearly enough by a wide margin. As you can see here, we've had some breaks below and breaks above. So the posture and that 40-week is still pointed lower. So that says bear market. This says bear market. I've talked on this many times, how I use the PPO or the MACD as a trend indicator. I use the 9 EMA, which is the white line. And as you can see here, other than this one period here, wrong drawing tool, excuse me. There was one period back in there, and this was actually a correction of, I'm sure that drop was well over, that was actually a bear market in the biotechs back then. They dropped well over 20%, and it did signal bearish. Other than that, you had a bullish cross back here in 2009, and again, barring that little brief period, which it did get you out of a nasty correction, although it happened pretty quick. You can call it a whipsaw signal if you want. It told you to get long and stay long. It gave you a buy signal all the way up until shortly after they topped. And you can see right now that 9 EMA is far from crossing back into bullish territory. So by the trend indicators that I'm looking at, by all metrics, we have the RSI is only just barely above the 50 level. This sucker's still in a bear market. And only hindsight will tell us, was this 61.8% correction or Fibonacci pullback, fib retracement, was that enough to really work off all the excesses? And bull markets are marked by excessive valuations at the high, and they're all, on the high side at the top, and they're also marked by excessively low valuations at the end. Now, there was an extreme amount. These biotech stocks always run with most of them very high PEs anyway, especially the smaller ones. But valuations were insane up here. They became much more reasonable. However, I don't think, in my opinion, they didn't hit bear market lows where you could say a bear market was over. Then again, it has a lot to do with the broad market. If the broad market's going to go higher, the broad market itself hasn't had a true bear market yet. So, all right, enough on that. Let's finish up on a couple of these other top stocks, and then we'll wrap it up. There's number 3. The third weighting is Tesaro, TSRO. Not much. You can see the patterns here. You had a little bearish wedge here, breakdown. There was a downtrend line, which was taken out with a gap. I mean, you couldn't have, in trading, if you were looking to position on a breakout, we had a little whipsaw signal there, but if you were looking to position on a breakout, that was, I don't know if that was earnings, probably clinical trial results, positive clinical trial results. I doubt it was takeover. It could be takeover speculation, but usually see the prices flatline, especially if it's an agreed offer. But I don't know what happened there. You just can't touch it. I mean, the charts can't read anything out of the charts. The weekly charts are a mess too. So I don't have much of an opinion other than, the pattern was bullish once that level was taken out, but can't really touch that. And I can tell you it's pretty lofty right now. I just don't know what's going on with that company fundamentally. ALKS is the next one up. Okay, here's another one. And this is a common theme. Remember, this all ties into XBI. When I looked at that XBI is approaching very key, very important resistance. You can see it here with ALKS. You can see how well this resistance zone, when I have two lines in close proximity, that's a resistance or support zone. You can see the reactions off this level, which defines each of these lines. There's an upper line defined by that, lower line defined by that, upper line there. So now we're coming on the lower end of that resistance zone, and this one actually has a bearish rising wedge pattern with confirmed divergence. You can see the negative divergence down here on the RSI and the MACD. You can see this wedge type pattern. Wouldn't be surprised to see it make it to the top of there because we had more reactions around the top of that resistance zone, but so far a little doji being put in today. Just something to watch. So there's one. Again, it comes back into, are you bullish or bearish? If it takes that out, it could burn through this divergence. If it takes out this resistance level, and that would be longer term bullish. But you could also you could put a short on in this stock with a stop not too far on a closing basis, maybe above 55 or so, adding to that position on a breakdown below that uptrend line, and that's ALKS. Biogen was one of my favorites recently. I mean, Biogen had this large falling wedge pattern. Had one, I circled it in orange, that was a false breakout or whipsaw signal, came back down, hit the bottom of the pattern again, and broke out. However, quite a bit of work to do, and that's the problem now with the biotech sector. I mean, that's a large divergent low. This divergent low spans going back, about 11 months, and we broke out. But so far we've hit resistance, and again, work to do on Biogen. But in longer term, you can look here on this weekly chart. It's just barely peaking above this downtrend line on the weekly chart, so might have a little more work to do. Might need to come back down one more time in there. And it's also struggling with that 200 or the 40-week EMA, which is the 200-day EMA. See the red line? It's just moved above it, but not enough for my comfort level. So there's Biogen. What's next? All right, BMRN. This is a weekly chart. There was a rising wedge confirmed with divergence. That's what I like to see on a weekly chart to, identify a primary trend change. And we don't have a divergent low. Prices made a low here, and there was no divergence in place. So maybe this is a stock right now. Quite a few lines here. From the bullish case, you can see this downtrend line I'm highlighting. We had a breakout and a back test and a lower level back test. It moved higher. You had this uptrend line here, and now I can draw this sharper uptrend line. So it's sort of wedging. It's just a confluence of resistance right here that stock has to deal with. You can see it to the left of the chart, and there's some levels above. I'm not crazy. I can't really interpret or draw too much from the MACD and the RSI right now, so just one I'm not too crazy about. What's next? Bluebird, I think. Yeah, Bluebird Bio. Nice falling wedge pattern. At a downtrend line, breakout back test. This line here and this line here form bullish falling wedge pattern. We broke out of that, and this is resistance around $50. These were actually old lines I had. I had support zone. This must have been for a short trade, or at least doing a video on this one. And we had that support zone, failed it, moved around here. So that 50 level, it's pretty important level. We're a little bit above it. I could probably move that line a little higher. It needs to clear that. Let's say 51. It needs to take 51 out. It still has some work to do. But if in the bullish case, if that holds up, I easily see that stock going up here at about 66.75 or so over time. Amgen, this is a big one in the sector. This was a former short trade here. We must have shorted somewhere here because I guess I had a stop over 167. Looks like the first target was hit. That would have been a 20 plus, maybe 30, 20% gain. But that level, that 167 level, was an important resistance level back then. And you can see since that point, I don't think that I've modified that line since then. Let's see, last time I've touched that line was I created it back on 8/27/15. Might have dragged it in, a year ago, over a year ago. Oh no, that was when it was created. Okay, that's it. Now we're just punching above it, but not by a huge margin yet. We have a very steep uptrend line here. You can see Amgen trades in a series. Look at these steep uptrend lines. See them all highlighted? That's how this stock works. It seems to stair step, or zigzag with these uptrends. Right now we have, for the first time in a while, these broke without any divergence. Now we have potential. I say potential because I need to see this MACD crossover, make a bearish cross. If it does before taking out that previous reaction high right there, so it needs to do so before this level. Same with the RSI. You don't want to take out that previous reaction high. So in other words, this one needs to turn down. It needs to turn down soon, and it would be a nice short. And Amgen's a big player in the sector, although it's, XBI pretty much equal weight sees this. Amgen only makes up 2.46, but it's still a big biotech stock, and I don't No, I'm assuming they haven't reported recent yet because I don't see any gaps recently, and one to watch. And if so, bullish case would be that it keeps going, takes out this level. This is your next resistance around 172, and then makes a, I'm sorry, and then burns through these divergences. Yes, that's the bullish case. Bearish case rolls over soon, and I don't know if they're scheduled to report soon. It could do so on a gap down, which would then certainly give us confirmed divergence there. All right, guys, I'm going to wrap it up here. This video went way longer than I thought it would. There were only a few more to cover anyways, Insight and Ligand. So there's Insight. You can just look at the chart, see everything you want to see, and there's Ligand. So those two are both bearish, negative, like the other one, divergent highs. So again, I favor the downside here. I think it's an objective time to short, but I just don't have the confidence yet for an official trade idea. But you guys, we all make our own trades. So if you want to make that trade, pull the trigger. If you have any questions about it, let me know. If you're bullish, likewise, let me know if you want to see some targets and support levels and stop areas. I'll be glad to share it. Okay, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.